A manager beat the benchmark. But was it skill or simply luck? A style bet, an easy benchmark, or a risk the client never agreed to take? Total return cannot answer that. This lecture opens the portfolio's black box, using style analysis and performance attribution to reveal exactly where results came from and whether they are likely to happen again. We will study performance evaluation, style analysis, performance attribution, and the difficult question of manager skill. When investors look at a portfolio, the first question is usually simple: did it perform well or poorly? But in professional investment management, that question is only the beginning. The more important question is, why did it perform that way? A portfolio may outperform because the manager made good decisions. It may outperform because the manager took a risk that happened to be rewarded. It may outperform because the benchmark wasn't appropriate. So, performance evaluation isn't just a ranking exercise. It is an economic diagnosis. We want to separate return that came from market exposure, style exposure, allocation decisions, security selection, risk-taking, and unexplained outcomes. We also need to distinguish absolute performance from relative performance. Absolute performance asks whether wealth increased or decreased. Relative performance asks how the portfolio did compared with a benchmark, a peer group, or the role it was hired to play. For delegated investment management, relative performance is especially important. Investors don't simply hire a manager to experience the market. They hire a manager to perform a specific job inside a broader portfolio. By the end of this lecture, you should be able to look beyond the return number and ask better questions about style, attribution, risk, skill, luck, and monitoring. Let's begin with style analysis. Style analysis identifies the systematic investment characteristics of a portfolio. In simple terms, it asks, what kind of investment behavior does this portfolio really represent? A manager may be described by asset class, geography, company size, value orientation, growth orientation, sector emphasis, quality, momentum, duration, credit quality, liquidity, or other persistent exposures. Style matters because two managers can earn similar returns for very different reasons. Imagine that a manager performs well during a period when value stocks are favored by the market. If the portfolio already had a strong value tilt, the performance may not be pure stock-picking ability. It may simply reflect exposure to a rewarded style. That doesn't make the performance meaningless, but it changes the interpretation. Style analysis helps investors answer several practical questions. Is the manager behaving consistently with the stated mandate? Is the benchmark appropriate? Is the portfolio adding diversification to the total investment program? Has the manager's style changed over time? Are there unintended exposures that the investor didn't want? There are two broad ways to study style. Holdings-based style analysis looks at what the portfolio actually owns. For equities, this may include sectors, market capitalization, valuation characteristics, and geographic exposure. For bonds, it may include duration, credit quality, issuer type, and currency exposure. Returns-based style analysis looks at how the portfolio behaves through time compared with style indexes or factors. Holdings show what the portfolio owns. Returns show how the portfolio acts. Now let's look more closely at returns-based style analysis. In returns-based style analysis, we compare the portfolio's realized returns with the returns of different style indexes or factors. The goal is to infer which combination of styles best explains the behavior of the portfolio. The idea is straightforward. The portfolio return is explained by exposure to selected style indexes, plus a part that remains unexplained. The estimated style exposures tell us how strongly the portfolio behaves like each style. In some applications, these exposures are constrained so that they can be interpreted like portfolio weights. That makes the results easier to understand, especially when the goal is to describe the manager's effective investment style. The residual is also very important. A small residual may suggest that the portfolio is mostly providing systematic style exposure. In other words, the manager's return can largely be explained by known indexes or factors. A larger residual may indicate active bets, concentrated positions, timing decisions, benchmark mismatch, or a model that doesn't fully capture what the manager is doing. But here is the key point. Residual return isn't automatically skill. It is simply the part of return not explained by the chosen model. That means returns-based style analysis is powerful, but it must be interpreted carefully. The results depend on the indexes selected, the time period studied, the stability of the strategy, and the quality of the data. Style analysis is a diagnostic tool. It helps us understand behavior, but it doesn't replace judgment. A manager's investment style shouldn't be evaluated from only one source of evidence. The stated strategy tells us what the manager claims to do. The holdings tell us what the manager actually owns. The returns tell us how the portfolio behaves. The risk measures tell us what exposures are driving uncertainty. The trading activity tells us how the manager implements the process. These different sources may agree with one another, or they may tell different stories. When they agree, the investor gains confidence that the manager is behaving consistently with the mandate. When they disagree, the investor must investigate. One of the most important issues is style drift. Style drift occurs when a manager's effective investment style changes over time. This may happen intentionally because the opportunity set changes. It may happen gradually because the manager changes the process. It may also happen unintentionally because portfolio decisions accumulate in a direction that no longer matches the mandate. Style drift matters because investors hire managers for specific roles. A manager who was hired to provide one type of exposure may begin to duplicate another manager, increase total portfolio risk, or become difficult to evaluate against the original benchmark. The question isn't whether an active manager ever deviates from the benchmark. Active managers are hired to deviate. The real question is whether the deviations are intentional, disciplined, and consistent with the role assigned to the manager. So, when we compare stated strategy with actual behavior, we are really asking whether the manager is still doing the job the investor hired the manager to do. Now we turn to performance attribution. Performance attribution decomposes portfolio performance into sources. It doesn't simply ask whether the manager beat the benchmark. It asks where the active return came from. First, we compare the portfolio return with the benchmark return. The difference is active return. Then we break that active return into meaningful components. The most common single-period attribution framework separates active return into allocation, selection, and interaction effects. The allocation effect asks, did the manager benefit from being overweight or underweight certain segments? A segment may be an asset class, sector, industry, country, currency, duration bucket, credit quality bucket, factor exposure, or any other category that fits the investment mandate. The selection effect asks, within each segment, did the manager choose securities that performed better or worse than the segment benchmark? This is the part most closely connected to security picking ability. The interaction effect captures the fact that allocation and selection decisions happen together. A manager may overweight a segment and also select securities inside that segment that behave differently from the segment benchmark. In plain language, allocation asks where the manager chose to be. Selection asks what the manager chose within each area. Interaction recognizes that these decisions are connected. Attribution is valuable because it turns a performance outcome into an explanation. Instead of saying the manager outperformed, we can ask, was it because of allocation, selection, or both? Attribution can make manager evaluation much more productive. Without attribution, investors may focus too much on the total return number. With attribution, they can ask sharper questions. Was performance driven by a sector overweight? Was it driven by superior security selection? Was it caused by currency exposure, credit exposure, duration positioning, or a factor tilt? Did costs reduce the benefit of active decisions? Did the benchmark represent the actual opportunity set? A useful attribution report must be designed carefully. The benchmark must be appropriate. The segmentation must match the mandate. The time period must be clear. Returns must be measured consistently. The report should also show whether there is a residual or unexplained component. Attribution becomes especially useful when the story isn't obvious. A manager may claim to be a strong security selector, but attribution may show that most of the active return came from a broad allocation decision. Another manager may underperform overall, even though security selection was strong, because a large allocation decision worked against the portfolio. Multi-period attribution introduces additional complications. Returns compound over time. Portfolio weights change. Cash flows may enter or leave the portfolio. Derivatives may create exposures that aren't obvious from simple market values. Currency effects may matter. Transaction costs and fees may not be easy to assign to specific decisions. So attribution should be treated as a disciplined approximation, not a perfect accounting system. It organizes the evidence. It doesn't automatically prove skill. Now we come to one of the hardest questions in investment management: skill versus luck. A manager has skill if the manager can add value in a way that is repeatable, economically meaningful, and not fully explained by risk exposure, benchmark mismatch, or chance. Luck means the outcome was favorable, but not because the manager had a repeatable advantage. This distinction is difficult because investment results are noisy. A skilled manager can underperform for a while. An unskilled manager can outperform for a while. Good decisions can lead to bad outcomes, and bad decisions can lead to good outcomes, especially over short evaluation periods. The starting point is often active return, which is the difference between the portfolio return and the benchmark return. But active return alone isn't enough. We also need tracking error, which measures the volatility of active return. A manager who earns active return while taking very unstable active risk is different from a manager who adds value more consistently. The information ratio connects value added to active risk. It tells us how much active return was earned relative to the variability of that active return. A positive information ratio may be encouraging, but it isn't proof of skill. We must ask whether the benchmark is appropriate, whether the record is long enough, whether the process is repeatable, whether costs and taxes are realistic, and whether future market conditions may be different. Skill isn't just a result. Skill is a result supported by evidence, process, discipline, and economic logic. Risk-adjusted performance analysis gives us another way to evaluate manager skill. The basic idea is to ask, after controlling for risk exposures, is there still return left over that may represent value added? The intuition is very important. A portfolio may perform well because it had high exposure to a rewarded risk factor. If that is the case, the return may be compensation for bearing risk, not necessarily manager skill. Alpha is the estimated average return that isn't explained by the selected risk factors. A positive alpha may suggest value added, but we must be careful. Alpha depends on the model. It depends on the benchmark. It depends on the sample period. It depends on whether the manager's exposures were stable. It also depends on whether important risk factors were omitted. Statistical uncertainty matters as well. Even when alpha looks economically attractive, the estimate may be imprecise. A short record can make it very difficult to separate skill from noise. A standard error helps us understand how much uncertainty surrounds the estimate. This is why investors shouldn't rely on alpha alone. They should combine quantitative evidence with qualitative evidence. Does the manager have a clear investment philosophy? Is the research process disciplined? Are risk controls consistent with the mandate? Are costs and turnover reasonable? Is the strategy constrained? Does the manager communicate honestly about mistakes and changes? Numbers can measure outcomes, but process helps explain whether those outcomes are likely to persist. Performance persistence refers to the tendency of strong or weak historical performance to continue. Investors care about persistence because manager selection is forward-looking. The real question isn't whether a manager performed well in the past. The real question is whether past evidence helps predict future performance. Strong past performance may continue when it is connected to a durable process. That process may involve a clear investment philosophy, disciplined research, careful portfolio construction, effective risk controls, reasonable costs, capacity discipline, stable personnel, and incentives that are aligned with investors. But strong past performance may not continue. It may have been luck. It may have come from a market regime that changes. It may have come from a factor or style that becomes crowded or less effective. Fund growth may reduce flexibility. Fees, trading costs, taxes, and implementation frictions may absorb the value added. The manager may change people, process, benchmark, or risk tolerance. Poor past performance also requires diagnosis. It may indicate weak skill, poor execution, excessive costs, or a broken process. But it may also reflect a style that was temporarily out of favor, or a benchmark that doesn't match the mandate. So investors should avoid two extreme mistakes. They shouldn't assume that strong past performance automatically proves skill. They also shouldn't dismiss every strong record as luck. A useful evaluation connects performance to process, risk, attribution, style, costs, and the investment environment. Return rankings alone are rarely enough. Let's finish by connecting performance evaluation to fund selection and monitoring. Performance evaluation is useful only if it supports decisions. Investors may need to decide whether to hire a manager, retain a manager, reduce an allocation, replace a manager, or change the monitoring process. A disciplined fund selection process begins with the role of the manager. What job is this manager supposed to perform in the total portfolio? What benchmark best represents that role? What active risks is the manager expected to take? What evidence suggests that the manager can add value after fees and costs? How does this manager interact with other managers and passive exposures? Monitoring should focus on both outcomes and behavior. A manager can underperform for acceptable reasons if the style is temporarily out of favor and the process remains intact. A manager can outperform for concerning reasons if the portfolio takes unintended risks, drifts away from the mandate, or relies on exposures the investor didn't intend to own. This is why investors monitor active return, tracking error, attribution effects, style exposures, concentration, liquidity, leverage, duration, credit risk, currency risk, fees, turnover, taxes, organizational stability, personnel changes, and capacity concerns. The final question isn't simply, did the manager beat the benchmark? The better question is the manager still the right tool for the job the investor hired the manager to do? That is the essence of performance evaluation. Thank you for watching. I hope this lecture helped you understand performance attribution, style analysis, manager skill, and monitoring more clearly.